Welcome to the Ask for the Skinny podcast with a guest. I'm proud to present Paul Musson. Paul, welcome to the show. Please tell us more about yourself. What is your story?
Well, thank you, Peter. It's great to be on your show. Yeah, so I was a professional investor for most of my career, managing mutual funds in Canada. I lived just outside of Toronto and loved my career. Great job. I loved being an investor and felt that I was playing an important role in the creation of capital, in the creation of wealth for society. Now, I was not a direct producer of capital, I was more of a facilitator. And so what I would do is my clients would create capital either through their own business or working for another company. They'd spend some of their capital, save the rest, give it to me. I would take their capital and I'd allocate it around the world to some of the best businesses who I thought would put it to the most productive use to create even more capital. Those companies would then hire more people, pay them more, profit would go up. That pushes the share price higher. My clients make money, I make money, everybody wins. And in a free market capitalist system, that's the way it's supposed to work,
Mhm.
is that you are only supposed to benefit to the extent that somebody else is benefiting from your actions. Increasingly, that's not happening, and we can talk about that. So, so I enjoyed my job, felt I had an important role to play, but over the years, I started recognizing what central banks were doing to the economy. Around 2001, 2002, in my opinion, they started sacrificing the real economy on the altar of higher asset prices.
Mhm.
So they started implementing monetary policy that was very distortive to the economy, either by driving interest rates to zero or by creating trillions of dollars out of thin air. They took these actions to deliberately drive asset prices higher. And and this comes at great expense to the economy, which we can get into. And so as I saw this happening, I became increasingly frustrated and worried about the impact that it was having. So I started talking to my clients about it. And my approach was always one of intellectual honesty. So my goal was not to impress my clients, but to educate them. Um, and in so doing, I empower them with understanding truth, enables them to better run their own business and help explain things to their clients. And over the years, so communication became a great passion and seeing the impact that it had on people. And so over the years, people said, Paul, you should really write a book about this one day. And I thought, oh, that's interesting, And then after a number of years, I said, why not? So it took me about 5 or 6 years because I was still working, um, and then I started. So the book is called Capital Offence: Why Some Benefit at Your Expense, and we can talk later about why it's called Capital Offence. And then in 2022, I started a free blog called Paulitical Economy. So it's my first name. Instead of political, it's my first name, Paul, then itical economy. And again, that was very organic. I would just started sending emails to my wife and my three daughters on a daily basis so they would know what's going on in the world. Very easy to understand terms. Like if you talk in financial lingo, you lose people because they don't understand what you're saying. And it's not that they're not smart. It's just that they don't speak that financial jargon. So if somebody asks you a question in Greek, you can't answer it. It's not because you're not smart. You just don't speak Greek.
Mhm.
So I'm trying to translate, if you will, what's going on to people who are not in the finance industry, very smart people and capable people and hardworking people, so they can contribute and have a voice. And so my wife and my daughters were sending it to their friends, and then people were emailing me I didn't even know. Can you put me on your list? I've been getting this, and oh yeah. So then my daughter set up a website for it. So now it's a free weekly blog. Your listeners can just go to my website and sign up. And so I left my employer about 3 years ago, so I could fully focus on my communication on my blog and talking about my book. And here I am.
Amazing.
Thank you.
I can feel you so much because I was in Zug also in finances, and when you say the monetary policy, I know what that does to funds.
Hmm.
You're fully
Yeah.
leveraged in one direction, and then
Yeah.
and then interest rate starts, and you get a haircut.
Yep. Exactly.
Instead of, as you mentioned, um, things like creating value and stuff like that being important when price equity ratio goes out of hands 10,
Yeah.
20, 25, then
Exactly.
it's just a numbers game. It does not have or the connection with the actual economy and moving of goods is so distant that it's
Exactly.
almost incomprehensible to an average person.
Yeah.
And everything is built on hope. So the future profits and future opportunities are already calculated in the stock price.
Hmm.
And um, the devil that I talk about is the buybacks,
Hmm.
and then the price goes north.
Well, it's really interesting that you bring up buybacks. I talk about this in my book.
Mhm.
You know that before 1983, most companies did not buy back their own shares because they were afraid of being accused of manipulating their share price higher, like
Yeah.
rightly so. And so the SEC at that time put in a safe harbor provision. And if you followed four rules when buying back your shares, you would not be accused of manipulating your share price higher. One of those rules was that you could not be more than 25% of the daily average volume in your own stock when you buy back your shares.
Mhm.
Well, in 1983, that made a lot of sense. In the 2000s, 2020s, that makes no sense at all. It's still 25%. If when we were buying stocks for our mutual funds, if we were more than 7% of the daily volume in New York, the high frequency traders would sniff us out really quickly and they would quickly drive the share price higher that we were trying to buy.
Mhm.
They buy it and they sell it back to us really quickly. And so we had to be extremely careful. Yet companies are allowed to be up to 25% of the daily volume in their own shares. And of course, that's exactly what they want to see. They want to see their share price going higher.
Yeah.
And so it just boggles my mind. Well, it doesn't really boggle my mind. I think I know why the rule is still in place, but there's a lot wrong with what's going on, that's for sure.
Can we talk about your book a bit, Capital Offence? I really like it, the title. And uh,
Thank you.
so, can you, what can an average person, average listeners that are in their midlife in the US, what will they get out of your book? What are the lessons that they will learn?
So I think there are a number of lessons. One of the issues is that we've all been fed this, no pun intended with the Federal Reserve, but we've all been fed a lot of economic myths
Mhm.
over the years, because these myths um, um, justify government spending, justify government deficits and debts, and so some of the myths are that inflation is required for an economy to grow. They always say 2%, that's their target. There is no truth to a 2% inflation rate being required for an economy to grow. Another myth is that the money, and it's related, that the money supply must increase for an economy to grow. No. During the 1800s in America, the money supply increased extremely slowly. And over that 100 years, the economy boomed, particularly in the last 30 years of the 1800s in America. The money supply grew only 4% or so, which is a low rate, believe it or not. But the amount of stuff being produced grew significantly faster than 4%. And so the prices, so there was more stuff per unit of money. And so the prices of stuff fell for 30 years. So people were becoming wealthier in real terms, even if they're on a flat wage. That's the way a free market economy is supposed to work, by the way. Even if you have a flat wage, due to innovation, investment, and freedom of competition, it competes way higher profits that the consumer is better off. But it's not happening because of monetary policy. And so my book goes step by step, explaining how things really work. The goal is to empower people, like I said earlier, I was doing with my clients, empower them with truth, understanding, knowledge, so they will have a voice for change. There's an old saying that the people always get the government that they deserve. In other words, you voted for them, so if you don't like what they're doing, shut up, it's your fault. Well, no, that's only true if people actually understand what's going on and can vote and demand accordingly. And when it comes to monetary policy and how the economy works, I think most people don't understand what's going on. And so we believe in this free lunch mentality that you can get something for nothing. If you take out more from the system than you put in, somebody else is paying for it. There's no ifs, ands, or buts about it. But we like to think that nobody's paying for it because we can't see who it is that's paying for it. And so if we demand better actions from our policymakers, they will do the right things. But for them to do the right things today would be political suicide. So for a politician in America, for instance, to say that Social Security will be insolvent in 2033 or 2034. So we're about 7 or 8 years away from it. This is the math. This is the numbers. This is indisputable. But to say that that's going to happen and we need to do something about it would be political suicide because the other party would say, no, don't worry. You're still going to get your benefits and you're not going to have to contribute more, during your working career and all that kind of jazz. And policymakers, I think, like most people, they're good people, want to do the right thing, but will only do it when the people demand it. And so that's why I wrote my book. And one of the most important things is to understand what money is. So, three of the first four chapters are all about money, explaining what money is, how it came about, the role that it plays, its functions, its importance, how it gets abused and distorted by policymakers. And then understanding the difference between capital and money. Two very different things, both very important. Capital is more important. So capital is anything that people produce, either a good or a service. So let's say you make a bike and I make a suit, and we both created capital. Now the economy is that much better off. There was no bike, no suit. You made a bike, I made a suit. We exchange it with each other. That's direct exchange or barter. And importantly, nobody suffered because of this. Nobody is worse off. I've got a I've got a bike now, but nobody's worse off because of that. You've got my suit. Now, when you introduce money, we don't do direct exchange or barter. We do indirect exchange. You're going to sell your bike first, for, let's say $1,000. And then you'll use your $1,000 to buy my suit. Now, this is where the trouble starts and how your capital can be taken from you. So, let's say you make 10 bikes of capital. Again, nobody else was harmed by that. You created 10 bikes of capital. You sell them for $1,000 each. So now you have $10,000. You put that in your bank account. That $10,000 is effectively, temporarily storing the 10 bikes of capital that you created, right? So your $10,000 has 10 bikes of capital stored up in it. Now you're going to use that $10,000 to go on a nice vacation at the end of the year. But before you get a chance to go on that vacation, the central bank doubles the money supply. Now, when central banks create money, they do not first create capital to obtain that money. They just create the money out of thin air. They press a few buttons. So that new money has no capital stored up in it. Your money has got 10 bikes of capital stored up in it. As soon as the new money comes into the economy, it extracts capital from the rest of the money already in the economy. So that money with no capital comes into the economy. It takes 5 of the bikes from your $10,000 and puts it into the newly printed money. So your bank statement still says that you have $10,000 in your bank account, but that $10,000 now is only storing 5 bikes of capital instead of 10 bikes. And so your $10,000 will only buy half as much as it would have done before the central bank doubled the money supply, which is, of course, inflation. So that $10,000 vacation you were going to go on now costs $20,000 and you've only got 10. The value of bikes did not change. The price did. And that's why my book is called Capital Offence, because when central banks increase the money supply, they extract capital from your money savings, from bonds that you may have bought, and the purchasing power of your wages.
Amazing. I
Thank
like
you.
how you talk about purchase power, value, and price. These are all also topics that are really dear to me, and I like to discuss them a lot. Also, I would like to ask one more thing. We said that we're gonna keep the politics out, but I just want to ask you. You're talking about the monetary politics. Can we talk a bit about the fiscal policy? You touched it a bit when you say that nobody will cut spending because they will lose their popularity, or you hinted at that. So it's really hard if we have um, different forces in our Congress, or uh, and now someone would like to introduce some kind of restraint and say, okay, we need to be careful. We should limit the money supply. We shouldn't print money, or we shouldn't continue quantitative easing all the way. But how is there any any alternative fiscal policy that than expansionist, that you just have to spend more and more in order to keep your power?
Well, sorry, I've taken off my microphone because it was I was getting some distortion there. Can you hear me okay?
Yes, loud and clear.
Yes, of course there is. You know, it's a myth that governments need to step in and spend in order to save the economy. If spending is decreasing in the private sector, it's because, well, it's usually a result of monetary policy that was too loose for too long, and you get misallocation of capital, and you get the economy gets distorted through easy monetary policy. And so rather than and I listened to one of your podcasts that you did earlier, you know, rather than let bad investment decisions result in failure, they come to the rescue and perpetuate the imbalances, which just makes things worse. Now, what it does, it saves jobs in the short term at the expense of losing even more jobs in the future. And so they're good intentions. They're just very short term in nature. They might be related to an election cycle or something like that. And both sides are guilty, by the way. The issues transcend politics.
Mhm.
And my belief is that because most people don't understand why life is getting more difficult for them, why the cost of living keeps going up, yet there's a certain percentage of the population that's doing extremely well. We'll talk about wealth inequality later. But people do see this and they don't know why they're getting screwed. You know, they went to school, they work hard, and so you need someone to blame, right? Because you're doing everything right. So somebody is screwing me. I just don't know who. So then it becomes very easy, like in America, for Republicans to blame Democrats and Democrats to blame Republicans. And up in here in Canada, the Liberals blame conservatives and vice versa. And then you get an increasingly divided society. And you pit people against each other. So here in Canada, we have increasingly political divide, just like you do in America. We've got a generational divide, baby boomers versus the next generation. Baby boomers, we'll talk about housing. I mean, we're benefiting at the expense of younger people. You got the divide of Canadians versus immigrants, you know, that because they overdid it. Canada had one of the best immigration systems ever. And I'm an immigrant. I was born in Wales. My wife's an immigrant. She's from the Philippines. You know, we're very proud of that. But like anything, if you overdo it, it ends up wrecking the whole system, and people get angry at each other. And you know, when you talk about the divide in America, how much it's increased, and I talked about this in one of my blogs recently. Right now, the presidential approval rating for Donald Trump is right along party lines. So 85, 86% of Republicans think he's doing a great job. Only 5% of Democrats think he's doing a great job. With Biden, it was the opposite. 85% of Democrats thought he was doing a great job, 6% of Republicans. But back in the 1950s, Eisenhower, who was a Republican president, 49% of Democrats thought he was doing a great job. And then in the early 60s, Kennedy, who was a Democrat, 49% of Republicans thought he was doing a great job. So there were differences, but there were much, as there should be. There should be differences of opinion. But the differences were much less stark in the past. And you could still have conversations and ask the other person, you know, why do you see things differently? Let me hear what you have to say. People can't talk to each other anymore, right? Republicans will all listen to Fox News, and Democrats will all listen to CNN and NBC and CBS and all that kind of jazz. And yeah, it's very sad what's going on.
But what can an average person take from that? What is our hedge against this nonsense? And you said you're gonna mention baby boom generation and uh, how older people are benefiting in comparison to the young people, and how the housing market makes it almost impossible to enter and
Yeah,
stuff like that. Can we talk about a bit about that?
absolutely. And this is a really important issue, and I mean, possibly one of the most important issues that we're facing today. So, the average age of the first-time home buyer in America now is 40 years old. It used to be about 29 or 30. Now, there are some social changes that happen along the way where people, put off buying a home. Maybe you got two-income families and building careers, whatever. But the main reason that people are putting off buying a first home is because they can't afford it. And it's gotten bad in America. It's way worse in Canada. It's way worse in Australia. Now, earlier, so what's happening? So earlier I mentioned that in a free market capitalist system, you're only supposed to benefit to the extent that someone else benefits from your actions. It's a mutual benefit system. Therefore, a house price has no business going up. A house is not a productive asset. Now, there are some exceptions. If some really popular cities, and you could argue that that economic good changes over time, which we can get into. But I use the example of our house here. We live in a suburb of Toronto. We bought it in 2001. This is just when the U.S. Federal Reserve, the central bank, started what I call their fake wealth effect policies. They took the advice of people like Paul Krugman of the New York Times and Paul McCulley of PIMCO, that they should start a new wealth effect in the housing market, i.e. drive housing prices higher. People will feel wealthier and spend more money, and that's good for the economy. No, it's not. Spending is not the fount of all economic prosperity. It's saving and investment, which then allows for greater spending. So they took interest rates, the Federal Reserve, by 2003, they got it down to 1%, which was an emergency level. Normally, you would only see that level of interest rates during wartime or something like that. But there was no war going on. The economy was still growing in America. They had done this to deliberately drive mortgage rates lower to drive housing prices higher. And then you had that crazy housing bubble boom in the mid 2000s. In the subprime crisis, they blew the whole thing up. And then rather than say to themselves, well, maybe we should not have interfered with the price discovery mechanism in the housing market, letting people make their own assessment with respect to risk return and how much house should I be buying based on my income. People were buying a house not based on their income, but based on how much they thought that house price was going to go up, and then they'd be able to refinance and all this kind of jazz. So house prices soared. Now, our house in Toronto is up 4 times from where we bought it in 2001, right at the beginning of these central bank policies. But our house is not producing 4 times as much stuff. Our house has not quadrupled in size. It hasn't relocated to a location that's 4 times better than where it is right now. It's the same economic good. It's the same economic good that a younger couple has to pay 4 times what we paid for it. So when that happens, when we make 4 times on our home, it's not a fair exchange of 4 times as much capital for that much money. It's a redistribution of wealth from the younger couple, their bank account, or an immigrant from their bank account into our bank account. Redistribution of wealth within society. There's no wealth created when house prices go up. It's just that the asset owners, the home owners, are benefiting at the expense of those who have to pay more now for the same economic good. So you're pitting generations against each other. Now, as you might imagine, I've been talking about this for a long time and telling people about it. And I think, as I mentioned, I'm 64. I've benefited enormously from this, and so have most of my friends, most people I know. And most people never thought about it that way. They just thought, well, you buy a house, the price goes up, that's just what houses do. But it gets to the point where if you're making money on your home, it gets to the point where the math no longer works. The people buying or are supposed to buy your home can no longer afford it. So that in Toronto, the median income is about $85,000, say. The median home price is about $1.1 million Canadian. In order to qualify for a mortgage for that $1.1 million home, you need to be making $250,000, not $85,000. So the median income required for the median house is 3 times lower than it needs to be. And so people, even if you could save, take them many years to save up for that down payment, a couple of $100,000 or $250,000, you wouldn't qualify for a mortgage. So for a lot of younger people, it's hopeless. And then they see people like me making out like bandits. Life was good for us. And it's not like my generation, baby boomers, it's not like we didn't go to school and study hard and work hard and life wasn't always easy, and we played by all the rules, but we were on the right side of these bad monetary policies. And so now you're stuck because, yes, politicians and policymakers would like housing to be more affordable for younger people. It's not that they don't want that, they do. But you cannot have that without prices coming down and eliminating a lot of the housing wealth that my generation accumulated over the years and then came to rely on to fund their retirement. But it's even worse than that. Because my generation saw their house prices going up and they factor that into their retirement plans, they started saving less. They started consuming more. And so, in economic terms, what it did was it increased the time preference of society. Now, what that means is if I, so if I'm earning money and I spend more of my money than I save, that means I have a high time preference. I have a higher preference for consuming things today. I want that pizza. I want to go on that trip. I want to get a new car. Rather than delaying my gratification, instead of spending, I save and invest. And when I invest my capital, I create more capital. And so in the future, I can consume even more if I'm willing to delay my gratification today. So that means I have a lower time preference. So in a society with a high time preference where people are spending and consuming more today, it means that there's less saved and invested, which means that there's less stuff being produced in the future. And now the future is now. It's not that stuff is not being produced. There's just much less stuff being produced than there otherwise would have been if we all hadn't started relying on the wealth being not created, or the house prices going up so we could rely on that. Effectively, the enormous mortgage debt of the next generation and newcomers to our country is helping to fund our retirement. And it's not going to work for the next generation because they already can't afford our homes. And if they did somehow buy one of our homes or were able to afford one of our homes, there's no way the price can go up because in generation behind them, there's no way in hell they're ever going to be able to pay for a higher price for their homes. So it's finite. It doesn't work. And as that old saying goes, if something can't continue, eventually it's going to end. And nobody wants to admit what the issue is because doing the right thing is very unpopular.
Yeah, I think everyone in economy today, including in Europe and Asia as well, um, they just act like they're completely oblivious to mathematical facts, and
Yeah,
they just don't want to convey the bad news. They don't want to be the bearer of the bad news. So
exactly.
let the next assembly or the next term take care of that. Let's hope that we get through this uh, without problems. And I do believe that, or at least for my expectations, um, everything that is happening since 2009, it's closer to magic than math because
Yes.
all this quantitative easing and everything, the market should have collapsed far sooner. But we'll see what happens. Is there any any advice that you could give to our listeners how to act or perceive things in order to be on the safe side or at least understand what's going to happen in the future?
Yeah, so Nobody knows what's going to happen in the future, that's for sure. There are a few different paths that we could end up going down. But being aware of the different paths or the potential paths is important because then that helps you structure your portfolio accordingly and even your emotional mindset. And so, in terms of an investment portfolio, my approach is to just be diversified in a combination of real assets and stocks or equities of extremely high quality companies with strong balance sheets and good corporate cultures that are really providing a true customer value proposition that I can understand and that are I don't think are too expensive. So I don't invest in AI stuff and all this kind of jazz. It's not because I don't think it's real. I think it is, but I don't know which companies are going to win, and I don't really know how to value these companies. I had no idea of determining whether or not they're expensive or whether they're cheap. It's a big mania right now, that's for sure. So I just sort of stay out of it. I've created capital through my career, and my main goal is not losing my capital. So the preservation of capital in real terms, and then try to grow it slowly. So I've got some high quality stocks. I've got some gold. My gold there is a hedge against central bank lunacy. Now, a lot of people will tell you that the only way out of this monumental debt pile and deficit spending, is through something called financial repression, where they cap interest rates and create enough money to buy bonds at a price that will maintain interest rates at a certain level. This is what they did during the Second World War and after it to a certain extent. This is very, very harmful to the economy. So it's called financial repression for a reason. You will be repressed. Your finances, your wealth will be repressed. Your capital will be taken from you through this policy. But if you have gold, your capital will probably, no guarantees, but your capital has a greater chance of being protected. So your gold, it's about $4,500 US an ounce right now, could go to 10,000. It's not that your gold will be worth more in real terms. It might be, but it won't be devalued. So that $4,500 ounce of gold, if it goes to $10,000, that ounce of gold will probably still buy the same amount of stuff it did when it was $4,500. It's just that the dollar's been devalued so much with all the. And then I've got some real estate. Now, real estate for the most part is overpriced. So, depending on the area or country where you live. So, if you can find some real estate that you are comfortable with the price you're paying, then I think it's not a bad idea to have some real estate in your portfolio. So far, central banks haven't figured out a way to print houses, right? They can't create houses out of thin air. And then, so I've got my high quality stocks, I've got some cash and some high interest yielding instruments, some real estate. And then, so I'm diversified, and then I don't worry about it too much. Because I know I can't predict what's going to happen. I know what may happen and what may likely happen, but I don't know for sure. But I think I'll be okay in any of those scenarios. It doesn't mean that my wealth won't go down if we have another, I mean, we could have another financial crisis that dwarfs the last one and a massive reset. And I've got a little bit of Bitcoin. There's a little bit of Bitcoin. But if that we do have a massive reset crisis, my wealth will probably go down, but not nearly as much as the markets in general. And then I'll be positioned to start growing again. That's just my own
I'm not licensed to give financial advice, so I don't really. But that's what I do.
Thank you, Paul. Thank you for all these insights, and thank you for being my guest tonight.
Well, you're more than welcome, Peter. It's been a lot of fun. Thank you.